This video should give you some understanding and insight into the different types of life insurance products, so you can choose the best policy for you. In the simplest terms, life insurance provides death benefit protection that can be paid income and estate tax-free if properly owned. The cost of any insurance policy is dependent on a few variables: your age, amount of coverage, length of coverage, your health, and the life insurance carrier you choose. So let's break it down. There are two types of life insurance: term and permanent. Let's start with term life insurance. Term is designed to provide temporary coverage for a specified amount of time, usually 10, 15, 20, or 30 years, and can even be up to 40 years. You might consider a term policy if you have a short-term need or if cash flow is a challenge right now. If you think term insurance is the right choice for you, there are still some additional considerations to keep in mind. As life changes, a growing family, changes to your health, a changed financial situation, your philosophy about life insurance may change too. That's why some term policies are designed to convert to a permanent policy without a medical requirement. And the cost is based on your attained age. This means that if you had a change in health, it would not impact your term conversion. Different life insurance companies offer different non-medical conversion options. Therefore, we highly recommend securing a term policy from a company that offers strong conversion options. Having access to these strong conversion options may increase your term rate slightly, so you should carefully analyze this issue when selecting a term carrier. Next, let's talk about permanent insurance. Permanent insurance is designed for long-term coverage, where the policy's cash value grows tax-deferred, and you have the ability to withdraw and/or borrow against the cash value without having to pay tax on the gains. When it comes to permanent life insurance, there are generally two types: whole life, which has a fixed premium payment, and universal life, which offers a flexible premium payment. Whole life, again, is a fixed premium product, which means that your payments will never go up. Additionally, life insurance policies purchased through a mutual company may pay dividends at the end of the year, which can be used to enhance the value of the policy in a number of ways. Because of this, whole life could be a great choice for someone who is looking for long-term coverage and a conservative level of risk. Universal life, or UL policies, are a bit more complex because they are very flexible in terms of funding, death benefit adjustments, and investment opportunities. Here are some key features. Rather than fixed premiums, you have the ability to vary your premium payments over time. You also have the ability to raise or lower the amount of coverage, though raising your coverage may require additional medical requirements unless you're converting a term policy non-medically. In this video, we'll cover three types of universal products: traditional universal life, variable universal life, and indexed universal life. Traditional universal life is unique because it may offer guaranteed death benefit protection, which actually makes it like having a permanent term policy, but it can also grow cash value. You also have the flexibility to shorten or extend the guaranteed period without future medical underwriting. Some products offer a guaranteed death benefit, and other carriers have the ability to raise or lower the cost of insurance being charged. This type of product is designed for a person who wants longer-term coverage, relatively low premiums, and a low-risk cash value asset. Variable universal life products are designed similarly to traditional UL products in that there's flexibility with your premium payments, tax-deferred cash value, and it can be accessed whenever you need it. The key difference is that with a VUL product, your premium payments are invested into separate accounts, similar to mutual funds, which allows for greater accumulation potential. You control the types of accounts your money is invested in, and you have the ability to move your money around internally tax-free. Because the policy is tied to the market, you can select the risk tolerance you are comfortable with and change the allocation as you see fit. A VUL policy has more application for the consumer who wants long-term coverage and wants to assume more risk in the investment portion for the possibility of a higher accumulation potential. Indexed universal life is somewhere in between traditional UL and variable UL. You still get death benefit protection, flexible premiums, the ability to adjust your coverage, and the tax-deferred cash value growth that other UL products offer. But with an indexed UL policy, the cash value growth is credited differently. Excess money from your premium payments earn an interest at a rate based on the performance of a market index, such as the S&P 500, but your money isn't actually at risk in the market. These types of products also offer principal guarantees, so your policy value can grow up to a certain cap, but there's also a floor guarantee, which means that if there's a down market, you can't lose more than the floor guarantee. This is a good choice for someone who's looking for long-term coverage and wants to take advantage of the equity market with the added security of a floor guarantee. As you can see, there are many different types of life insurance products available. And while they may have a similar purpose, giving you security knowing that you're covered if something unexpected happens, there are many variations and options to consider. If you're interested in a life insurance product, it's best to seek out a qualified professional. We'd be more than happy to chat and/or meet with you to go over some examples and models to help you find the best policy for you. Give us a call at Rosenzweig Financial Services at 212-818-0505 or visit our website at www.rfsny.com to schedule a meeting.